Well, a warm welcome to everyone, and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned financial planning firm in Brisbane. Today we have Ken Liow, who is Head of Strategy and Risk from Realm Investment House. Ken joined Realm in 2013 and has over 30 years of industry experience. Ken was previously a Managing Director at BlackRock, where he served in various roles including Chief Investment Officer of Domestic Equities, Head of Investment Strategy of Scientific Active Equity, Chair of Risk Management Committee, and member of the Executive Committee. He led the team which built the Australian quantitative equity business from inception. Prior to BlackRock, Ken was Head of Investment Research at Mercer. He has advised several investment institutions. At Realm Investments, Ken is Head of Strategy and Risk, where he's responsible for assessment of macro environment, determining its implications, and ensuring that portfolio risk levels and composition are appropriate. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussions, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your objectives, financial situations, or needs, so it's not a recommendation. It's important that you consider if what we discuss today is appropriate for you before acting on it. Please also refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website. If you'd like to talk with Solace Financial regarding your current financial situation or whether your financial strategy is suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment.
Thanks for joining me today, Ken. As a fund manager specialising in fixed interest, can you talk us through Realm Investment House investment philosophy and history?
Yeah, so Realm was formed in 2012, privately owned organization. We've grown step by step over time and launched product after product. And we're now reached the point of 7.5 billion with 30 staff and 19 investment professionals. All we do is run credit investments, that's domestically and global. And we have 4 major product lines that are, each has been successful in its own right, delivering on its targeted investment objectives. Our investment philosophy, our investment process, if you like, is built around a concept of what's called relative value. That's a concept essentially that focuses on mean reversion as the primary driver. In other words, for example, triple B, a corporate credit, for example, the spreads available, unless they're credit spreads, you don't see them go below zero, and you don't see them launch off to 50% and stay there. So what you see is that they rotate around, and it sort of sits around an average of about 1.5 to 2% on average through time. And if it gets above 3%, you normally don't see it lasting there for very long. It's a crisis, something's going wrong. People get panicked for a little while, but eventually it settles back down again. So that's mean reversion at the absolute level. But you also see it, in a level below that. So, for example, you'd be familiar with what a bank hybrid is, and you'd also be familiar with, say, a general corporate that's out there, which is investment grade rated triple B. And on average through time, you'll find that the bank hybrids might trade as, with a spread of maybe 1% on average, around about 1% on average, over a triple B corporate of similar maturity. And that's a relationship that's sort of fairly robust. And if you should find that the markets aren't trading at those levels, it might be an opportunity to switch into the one which is a bit cheaper and wait for that reversion to occur. And it goes down one level below that as well. You'll find individual names move around with relationships against each other or their competitors as well. And so in fixed income, the mean reverting behavior that is very strong at all those levels. And a relative value process essentially looks for conversions to those means, to those sort of longer term averages. We adjust them for things that have happened, of course. But when you're positioning for those things to return, it's another way of saying buy low, sell high.
Okay. So when you take into account buying low and selling high, how do you assess the investment risk when you make the decisions?
Yeah, so investment risk is with credit, you've probably heard it over and over again. Your upside in credit is just to get your money back.
Yeah.
And then if something goes wrong, you can really lose a lot. So you're really focused on managing the downside risk when you're when you're a credit investor. It's very much unlike an equity manager where you're looking for the upside a lot of the time as well. So within credit, we do the standard analysis begins by making sure, by checking whether or not a company can actually meet its promises and repay its debt. So you're doing simple things like, or simple in concept, just checking their profitability, looking at their cash flow needs, which includes, any capex requirements or maturities that are coming up, or any refinancings they need to do. You're looking at the asset coverage to make sure that, what's on the books can actually, in the worst case, be sold and try to recover your assets. So that's at the very basic level, and everything you're doing there is just to make sure it's got a pretty good chance, a very, very high chance of repaying its debts. Then you go one level deeper, then we start to sort of position for the fund, sit there and go, what is it worth? Okay, so you've now got a concept that you're going to get your money back with high likelihood. You've now got to say, what's it worth? How much should we pay for this bond? So one level beyond that is you've got to check things like, what's the credit trend? So in other words, what's the ratings houses, for example, are very influential about what the opinion of a bond actually is positioned off in the market. So you've got to be aware of what they're thinking, what the risk points are, to make sure that you allow for any uncertainties that they have, or even maybe they're optimistic about it, and to allow for that as well. You've got to check about the management's policies as well. So you need to see whether or not they're committed to maintaining debt ratios, for example, and not seeing them deteriorate, or you've got to make allowance for that risk. You've got to allow for things like, will it be hard for them to refinance this debt? So, for example, any companies which have got significant coal, or ESG concerns about them, financing for those organizations is actually very hard to obtain nowadays. So you need to make allowance for the possibility that they may not be able to roll that debt on anywhere near the same sort of pricing that they managed to get it away in the first place. You need to make allowance for that. And then there are technical elements within bonds. Sometimes they've got calls, or they've got resets, or they've got something else that's going on, some sort of other characteristics which may offer some protection, or in some cases put you at further risk. So there are some details inside the bonds you need to be aware of as well. That's just to figure out what it's worth. And then to go on, Realm is very focused on risk. So let me go on. As we then decide to implement it into the portfolio, we then need to think about the liquidity. So can we move the asset around? How does it affect the overall portfolio's liquidity? Because we need to make sure that we can stay nimble in difficult times, and clients never feel worried that they can get their money back when they want to. We need to check whether or not adding that individual line blends in with other things that we're holding. So, are we overly exposed to the industry already? Are we overly exposed to its competitors, or something up and down the value chain, so its customers or its suppliers, so that the whole thing moves as one? We need to think about country allocations, and currency allocations as well, to make sure they're nicely balanced. At that point, you have the full portfolio. And then once a week, we have a very detailed risk management meeting where we look through and have a look where the risks are in our portfolios. And risks is not there to be minimized. We're in the risk management game, right? We're not in the sort of risk minimization business. You can't do anything if you're just minimizing risk all the time. So what we need to do then is to make sure that where the risks are in the portfolio matches or closely resembles our insights, the relative value that I was talking about before. We then have a notion as to which parts of the market we think have got better prospects and which are more dangerous. And you need to make sure that where you take your risks is sensibly related to those insights. And of
Okay.
course, then we ask ourselves finally, what could possibly go wrong? And there are many, many things that can go wrong, of course. So we scenario test, a whole range of different things, and put on hedges as necessary to protect against the most egregious of those as we see it. That's
So
the answer for us.
you've got a very extensive risk management strategy in place. How do you then see opportunities, risks that are out there in the marketplace at the moment?
Yeah, right now it's an interesting market circumstance. Like, spreads have never been tighter in 25 years, and you only very rarely see them tighter than this, even if you extended it way back into history. So you begin in a place where spreads are, there's not much return being offered for credit. Um, and why is that? It's because the market's very optimistic at the moment. Like, even with President Trump coming in, the optimism in the market is like, amongst small firms, is, hasn't been as optimistic for maybe decades. So if you look across the Western markets, in the end part of this year, early part of next year, everything looks to be, in equilibrium. So in other words, the economies will be kind of running pretty well. Unemployment wouldn't have moved very much from where we are today, certainly nowhere near enough to cause much distress. People's buying power will have recovered because inflation rates have come down, will be at sort of fairly normal levels. There might even be a few interest rate cuts along the way. So when you look at that picture, everyone's feeling really optimistic about things. But as a credit investor, it's the most dangerous time. So that's if you like the sort of major risks in the market, and there's plenty that can go wrong, of course, from this front. So for us, because we're relative value investors, it's really strange when what's the risk? Well, the risk is it stays the way it is for us because we can't make the money that we do when you sort of see disturbances in the market. When you see disturbances, it's when the process really goes to work. It sort of like tilts to risk. It tilts to the parts that are, if we think the money's still good, tilts into the part where the markets are most concerned. And so for us, what we like to see is that there is actually plenty of opportunity for these sorts of events to occur. So recent events would have been things like, they're not good events, but it might be like the outbreak of hostilities in the Middle East, for example, or the European parliamentary elections, which didn't go so well for certain parties and caused, minority parties and minority governments to be formed in France recently, and so on. It can be things like the collapse of SVB or the UK mini budget. It's those sorts of events that create good opportunities for us. And although they may be called risks in most other reports that you'll find, for Realm, we're kind of waiting for them to occur, and we expect to do quite well, when they inevitably arise.
Okay. So can you talk us through the greatest strengths that you guys have as a fund manager?
Yeah, so I think that look, Realm's done. Our performance has been very strong since our inception. Like every one of our products has met its targets. That's a pretty uncommon thing to do. And we've managed to deliver these returns with very high risk-adjusted results. So how do we do that? Because I don't think that what we're doing, we don't have, you know, we're not claiming to be able to have incredible insights that the rest of the market, doesn't have, or anything of that nature. So, our ability to do that, I think, rests on three key things. So the first of those is, again, the relative value philosophy that I mentioned. It is a simple concept that in a mean reverting market is simply buying low and selling high. It's not a complex concept. You can see it and you can extract value from it. So it's not magical, but the hard part of it is to actually do it. Because we can clearly see that although the opportunities are available to many people in the market, many people can't produce the results that we have. So what else is going on? The next thing that happens then is you look at our client base, and we're grateful to you and your clients as well for recommending ourselves to them and entrusting your funds with us. We have a very diverse client base. There's not one single client out there who could really remove their money and terribly concern us from a financial perspective. And because through all these cycles that I've just mentioned, when there's plenty of opportunity to panic, if that's your nature, you find that our clients don't do that. Like they very often don't do anything, or more often than not after that, actually choose to invest in a contrarian fashion with us, doing exactly what we're doing already. So when you've got a client base that demonstrably thinks medium term to longer term, you can think for the medium term and longer term as well. And then finally, to build on that, is we're a private partnership. So we're not beholden to having to report to some offshore group that's watching a quarterly P&L, or career management in that way, or a public entity that has to do something similar because of a share price. We as a partnership can think for the medium to long term and take risks along those lines as well. So I think when you combine all of that what our really sustainable edge is to think for the medium term. And this is really important in crisis when the market's thinking short term. And when you put that together, it's those bursts of concern that again generate great outcomes for us and our clients. And we're set up in this way to go and grab those.
Okay. Can you talk us through a time when you've turned a period of poor returns into an investment opportunity and turned the performance around?
Yeah, so as a contrarian investor, they all look like that, right? So when something's going wrong, you're losing money because you're exposed to the market like everybody else. I mean, we are exposed to credit because we're a credit manager, we're holding something. And so if the credit markets sort of weaken, we will be taking losses. And again, the forecasting of these things in the short term is not something we claim to be very strong on. And I would suggest that it's not really very possible to be very strong on short-term forecasting. So we don't try to finesse that at all. So as things are getting worse, we're really building into those into risk positions because again we're a contrarian investor, and the relative value process would naturally lead you to be extending risk into those circumstances. And sometimes it really gets going, all right. So one example would be when SVB and Credit Suisse fell over. So SVB was that Silicon Valley bank, which in March 2023 suddenly had a deposit flight, like they went bankrupt in an afternoon. So, and that through all these incredible mechanisms caused a loss of confidence in Credit Suisse across in Switzerland, which had no lending relationships. Okay, so it was this interesting way the markets work. Opinion becomes fact. So Credit Suisse was obviously a very significant financial entity. Issues a lot of senior debt and tier two, and also significantly hybrid debt. Now, because of its size of the organization, it issued a fair chunk of the outstanding hybrid debt in the world, and it went to zero. All right, so I think you'll remember that those interesting times. Now, that obviously caused a pretty big spook in the market when suddenly something which was Credit Suisse debt, I mean, you knew there was hairs on it, but it can go to zero, caused a panic in the market. And there was, we were holding, not Credit Suisse AT1, we weren't holding that. We had a better story actually. We were holding Credit Suisse senior debt, which became UBS debt. So that was it was a really big win for us. But let's focus on the hybrids for the moment. We were holding other hybrids, and as the whole market was being sold off, obviously our fund's performance was being drawn down. But our contrarian approach then leads us to do as follows. You go like, we can see it's being indiscriminately sold. This happens because there's levered money, like hedge funds participate in this market significantly. And when they take a loss, a couple of things happen. The leverage that they had but the day before it happened suddenly becomes worse. So they become over levered. And people who are lending money to them also look at things like value at risk type measures to see, what the probabilities are of losing money. And those probabilities get spiked right up whenever there's a sort of big risk event that's happening in the market. So for several reasons that you have certain kinds of money in the AT1 market, which are kind of compelled to sell, suddenly lose a lot of confidence, and their clients will be pulling money out as well because they've just taken really big hits. So there's urgent selling going on in the market, and it's quite indiscriminate. And you'll actually sell the more liquid lines first because you can just get your money back. So everything's being thrown out, and you can see that's what's going on. And then you can find opportunities like in banks like Deutsche Bank or Barclays, which they have certain features that people can get very worried about suddenly, but you just double check about what those concerns are. You double check to see whether or not they actually are valid and real in the current moment. And so we were looking at things like possibility of deposit flight and Deutsche and things. We were looking deeply into these sorts of issues. And you find that those risks weren't being realized. It was just kind of like the market's worried about it, but the risks weren't developing. So because of those reasons that these things are again being thrown out as baskets, we then bought heavily into certain names that were the ones being sold off that kind of get worried at the same time, but aren't Credit Suisse, different business model, everything like that. We also protected against the possibility of it getting suddenly worse for reasons we don't know about, but things can happen like that. So we protected against the downside of those. And then eventually, of course, these things settled down. And we made very, very strong returns after that. So this is, I guess, the kind of reason why I mentioned again that we need volatility for our processes to work really well. And the great thing about it is there's all sorts of potential for high volatility, sitting around the market right now, despite the fact that the market's pricing, very, very optimistic outcomes.
Okay. Can you talk us through any of the recent investments or trades that you've made?
Yeah, so at the moment, again, spreads are very tight. So the sorts of things that we're doing is finding, just parking money in a safe spot right now. So fairly high investment grade corporate bonds that are shorter duration in nature is where we're putting most of our money. But there are some interesting pockets that are going on as well. So when spreads get really tight, people don't differentiate very much between, let's say, a triple B credit and a triple A rated credit. For them, it's kind of when things are all simple and easy. They're like, what's the difference? Everything's safe anyway. So you find that the spreads between triple B and triple A assets at the moment are quite narrow, and they're particularly narrow in certain elements like in structured credit, which is residential mortgage-backed securities and things of that nature. So certain pockets of the market are very, very tight. Now, it turns out, of course, that there are certain people who only invest in investment grade assets, And there are certain people who are also comfortable to invest in sub-investment grade assets. Some do it all, but there, again, there's a difference. And because of the behavior in the investment grade markets where people just aren't differentiating risk, there's a huge gap between one step below investment grade and investment grade. There's a very, very big difference in there. So in pockets of the market, in a very risk controlled fashion, we're finding those elements in the market as well and adding them in a risk controlled fashion into the portfolio as well.
Okay. Now, how do you stay up to date with all these changes in the financial markets?
There's a lot of us in there. So you've got a lot of screens blinging, green and red all day long, lots of news coming through. Well, to start off with, we've got 19 investment professionals. So we do break the load up between us and focus on in our parts of the world that we need to focus on very strongly. But the important thing here is, although there's a lot of news, there's not a lot of it that we really, really need to focus on. So our relative value approach produces, we're actually screening the market the whole time. We're screening in excess of like 6,500 securities at any given moment. But it's done in a very efficient fashion. So lots of data comes in. We have our own sort of data management teams. It gets organized, it gets screened, all the good ideas pop to the top. And we only ever invest in the names that are towards the top of that list. And there's actually a smaller number of those. And as a result, a small number of things that really matter that we focus our time on. So I think that, again, we're very well resourced. We do cover the market, but the idea here is you don't need to cover it like that. And you need to cover it only for a small number of things that really matter. And although we're trading every single day, the mindset that we have is what's the outlook over the 6 to 12-month period? And when you think of it that way, you start cutting out the noise and you're just focusing on the things that really matter. So although there's a lot to cover, although we work very hard and very fast, it just looks like this controlled, it looks like everyone's in control but working hard type environment as opposed to what you might see on some Wall Street movie.
Okay. And what would you say makes a good portfolio manager?
Oh, wow. I tell you what, you can't tell by just seeing somebody. You can't tell, okay? Because they're as different as there are individuals amongst us, right? Some are better, some who would be great at equities can't do credit. Some who do credit can't do FX. Some can do all sorts of different things. Some think short term, others think long term. They can be analytical, they can be flow oriented, they can be gut oriented. Some are iconoclasts and can't work with anybody. Some are great in teams, right? So all of that's possible, and you can get great portfolio managers from just about all of that description. But the ones then I've seen who then amongst all that possibility then become the great portfolio managers, I think have got the following things in common. So firstly, they accept that this is a hit rate game. There's no one who gets anywhere near 100% right, like nothing like it. So you just accept that that's the case. And then you hold your ideas lightly as a result. So you just sit there and go, I think this, but I know it's probably 55% chance of being right. And you know what? If it should be the 45 this time was a good beat, that's okay. I won't get too damaged about it. I'll listen to why I got it wrong. I'm happy to take the criticism. So I'll learn the next time. They might be, they're not unemotional. They just don't allow their emotions to be affected by that. And so what you then find is that, again, they don't alter their behavior as a result of a couple of runs of goods and good or bad. I mean, like deep value managers, for example, can be underwater for years. And they have to hold that position and for that process to work. And as a relative value investor, I get in credit because it doesn't take usually 3 years to mean revert. We're exposed to circumstances like that. When things look worse, it's actually the best for us, but you're underwater. You've just lost some money, and you've got to be loading into Barclays when we're underwater, right? You've got to be able to do that. So there's those sorts of characteristics. Just not getting too low when you've had a few losses, and really importantly, this is very dangerous in PMs, is when they've had a great run. Again, not suddenly thinking that their ability to see the future is any better than what it was, before that either. So those are the really important things. I think just to extend on that, the other things that are in common is that they don't have to do everything from scratch. They understand that they can build off other people's ideas, and they're just there again to look at the small number of things that really matter. So they tend to be very, very well connected, and you just go to the small number of people that need to go to any given idea to get those best ideas, figure out what they need to, which is typically only 10 or 20% of the problem, and then come to a conclusion and just do that over and over again quite quickly. Yeah, so that's what I've observed the good ones have in common.
Okay. Now, Ken, we've covered a lot of ground this afternoon on a Friday before Australia Day. Is there anything else that you'd like to add that we haven't covered?
I think I'd just like to finish off by saying, if you think for the medium term, if you can actually do that, you start a long way forward from where most people are in the markets. And I like to think that that's where we are.
Yeah, okay. That's a good way to think about it. And we have the same conversation with clients. You can't think short term. You got to think medium to long term. But Ken, I
Perfect.
appreciate you making the time to talk with me today. And I look
Lovely.
forward to speaking to you again in the future.
So it's been a pleasure. Thanks very much.
Thanks for your time again, Ken, and explaining the complex world of fixed income investing. I appreciate you explaining Realm's philosophy and history.